Between your last interaction with us and now, tell us, what have you been doing? Have you been allocating incremental capital to Indian stocks?
We continue to remain constructive on Indian equities, and incrementally we've been adding in the consumer discretionary, cement, and some subsectors of infra. So largely it is otherwise unchanged. We've been taking some money off the oil sector because while oil prices have fallen about 14% in the last couple of weeks, few things like global oil prices or the rupee movement versus the dollar, or whether it's the government policies, do not remain under the control of the oil companies. They're all up about 40% year to date. So we've taken some money off the table.
Right. Chakri, also, of course, you mentioned about the oil and gas sector and taking money off the table over there, but the primary theme of the market was profit booking today. And we did see in this scenario also mid-caps rise, while it was the blue chips which took a knock today. So what has been your investment theme going forward? Do you think that mid-cap is a space that you would invest in?
If you look at the earnings growth thus far, the large caps have grown faster than the mid-caps. And going forward, as the economy revives, we think the earnings growth for the mid-cap will be north of 20% in FY15 and maybe 25% into FY16. And so we've been increasing our weightage into mid-caps to about 35% of our portfolio.
Right. Chakri, tell us about, you spoke about sectors, but if you could share us some specific names where you have really added allocation, and also give us your rationale of why do you really add positions there, what triggers lie ahead for those stocks?
Well, we've been, as I mentioned, selectively adding in various subsectors of consumer discretionary, as we believe that if you look at, for instance, the latest earnings report from InfoEdge, Naukri.com indicates that job growth is reviving. As job growth revives, consumer discretionary spend revives. So we are adding selectively to paints. Now paints is a reflection of both consumer demand as well as corporate demand coming from higher automobile sales and therefore higher industrial paint sales. Residential sales, that is housing units, sales have hit a 3-year low, and as interest rates ease going into next year, job revival happens. We believe that as a result, consumer discretionary will do well. Second, cement. Regional cement companies have done well, like JK Cement, JK Lakshmi, and are still attractive. But pan-India plays like ACC, who can participate in an all-India growth and also participate in a revival of growth, let's say, in the south, we've added there. The third, the trigger is logistics, is a very important sub-area of infrastructure. And we've been adding selectively to positions like in gateway district parks, which will benefit from both in domestic economic revival as well as in all this thrust to ease supply constraints.
Apart from this, Chakri, you mentioned that you have taken off some money off the oil and gas sector. Which are the other sectors or some of those stocks from which you have made profit booking in this run-up?
I think largely we have left things unchanged otherwise, except for taken money off, like I mentioned. In select PSU banks, we've also taken money off, while as a sector we still remain overweight financial services. But otherwise, largely we are our portfolio remains largely unchanged. We are overweight cyclical sectors, now adding to consumer discretionary, and underweight, or you could say, staples.
You spoke about financial services remains as a big overweight for you, but as an FI, how perturbed are you looking at the sequence of events which have happened in the banking sector? Some irregularities and some scams have been reported, and net, how are you positioned on the banking sector?
I think what has happened in the banking sector, if we look back for the last 2 or 3 years, a few things have happened. On one hand, you've had policy inaction, which led to policy inaction, delay in cola allocations, environmental delays, including farm loan waivers recently. And all these have increased the stress on banks, increased NPA concerns. On the other hand, you have stressed corporate balance sheets, and then some of them willful defaulters at that, which has also led to increasing stress on the banking, on the PSU banking sector especially. But however, the valuations kind of reflect all these various negatives. Many of these banks are trading well below their book values. So selectively there is good value. SBI among the PSU continues to look good. Various other mid-cap PSU banks also continue to look good. I think what we should, what as an FII we hope to see is some amount of gentle reform which invigorates the banking sector, streamlines the banking sector without choking on growth. And on the other hand, we still have what you call a decent overweight in private sector banks and NBFCs. And one more thing, I think, the last thing I'd look for as an FII is recapitalization of PSU banks is a very important thing, and I hope there are some announcements in that regard.
That's right, Chakri. Those announcements are yet to come, and I wanted to understand how are you positioned in terms of your portfolio now? What percentage of your portfolio is now tilted towards mid caps, and how much in large caps, and have you tweaked it recently?
Yes, that's a good question. I think going forward, we expect, as I mentioned earlier, earnings growth to be stronger for the broader market. And also, if you look at Nifty, its composition does not adequately take into account consumer discretionary. Consumer discretionary is reflected through auto, but there are various other pockets like restaurants, etc., which are not reflected, or various other pockets of consumer discretionary. So we are capturing that growth by having 35% of our portfolio in mid caps versus another 65% in large caps. And as we believe, there will be an EPS revival, and it will be a fairly strong one at that as we go forward into the next 24 months.
Chakri, you spoke about EPS revival. Looking at how did you analyze first quarter earnings in the first place, and where exactly do you see the earnings growth for corporate India or Sensex, which is a representative of that, heading over the next couple of quarters?
If you look at the current concluded quarter, the top line growth was actually a healthy about 13 to 15%. Bottom line profit growth was a healthy actually 16 to 80% in spite of a weak economy. So as we envisage the government to take various steps, right now it is still in an administrative early stage mode. As we see policy clearances and a streamlining of various policies going forward, we would expect this earnings growth to be 20% plus in FY15 and maybe 25% plus in FY16. Where is the growth going to come from? On one hand, at a Sensex level, is one, you have an export related growth, which is IT and pharma. Both are doing well because of the US is doing well. And in the case of IT, I think top line growth should be about 15% for the industry. And in the case of pharma, you are seeing a better pricing in the US for generic pharmaceutical companies, as well as higher volumes. Both these should translate into higher profit growth, including currency benefits, especially more for the mid-cap pharma and also for the large-cap pharma. On the other hand, on the domestic side, we see banking growth to be stronger going forward, especially for private banks and select PSU banks. And on the other hand, infra, with all the thrust and anticipated policy clearances, I think those two areas, banking and infra domestically, and IT and pharma and export sectors, should take earnings growth for the Sensex to be 20% plus for FY15.
Chakri, just final question from you. You said US is recovering. It has its own set of side effects as well. FII inflows into India have been very strong. How do you see it going forward? US is recovering. There could be some tightening in the monetary policy. The QE is tapering. Do you think the FII flows are expected to be as healthy going forward as well?
Good questions, all of them. The US economy is doing well. US employment is picking up. At the same time, US inflation, consumer inflation, continues to be very low at around 2%. So the risk of a hike in interest rates in the US remains very low, at least for the next 1 year. On the other hand, you have the US corporates, which are very strong. Balance sheets are very healthy. So this should keep the Indian IT companies and Indian pharma companies strong, as we just discussed. And this gives adequate time for India and the Modi government to streamline its various policies, so by the time that you see these interest rate hikes in the US 1 year down the road, we have a revival in the domestic economy, which reduces the risk of a capital flight away from India, and it also increases the chances of an improved credit rating both at an India level and at an Indian corporate level. So we are positioning for this scenario, as we believe this government, the Indian government, will deliver on these fronts as we go forward, and we're positioning our portfolio for a 20 to 25% earnings growth in each one of our individual stocks in our portfolio.
All right, Chakri, we'll let you go on that one. Thanks a lot for taking time out for us this evening and joining us on the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.